before we start, Andy reminds me that I didn't think we needed any stinking rules, but Andy reminds me we need to go through the rules of the road. Everybody's seen these, similar to what all of our friends from Invest Tools and talk about. No one in these meetings is offering any trading or investment recommendations. Everybody's responsible for your own trade. Anything we do here is just paper. We talk about the way that we might trade, what we might do, but again, it's only paper. It's not a recommendation. And everything here is for information and educational purposes. Nothing is investment advice, and you would be crazy if you accepted any of our advice in the first place. So everybody's responsible for their own trades. I know everybody here knows that.
What I'm going to be talking about to start off today with some basics, and then I'm going to go to some more detail in the coming weeks. So just a real quick, everybody can see my screen. I see from John that says yes, and hopefully you can hear my voice.
Yes, yes, Andy, see you and hear you good.
Good, good. Okay. As I'm going, if you have any questions, comments, or anything like that, please feel free to unmute yourself and jump right into the discussion like everybody has all day, which I really appreciate, by the way. These meetings are a lot more interesting when everyone participates. So with that, I'll go ahead and kick this off. I'm going to be talking about using options to create synthetic stock positions. The strategies I'm going to be talking about are can be used with any ticker. I personally tend to focus on a single ticker. I use SPY. One of the things I'm going to be talking about is why I've chosen that ticker to work with exclusively. But the strategy can be used with anything that against which options are traded. So, if you were in Dallas, some of this may sound repetitive, but this is the kickoff that I like to use. I've got some updated slides here, and some of the others coming up are going to have to be modified. But so let me just go ahead and get things started. Let me give you a little bit of history real quick as to why I use this position and how I found it. I found over a reasonably long period of time that I am really good at losing money when trading option strategies. The reason basically came down to the fact that I would try to get in at the wrong times and try to get out at the wrong times. So I could be trading bullishly and still be losing money. It was really driving me nuts. So I finally decided at one point, what I'm going to do is I'm going to take a year off. I'm not going to let myself trade any option strategies. Still going to study them, still going to paper trade, but no real money. And at the end of that year, I was going to make a decision about whether or not I was going to trade options at all. And during that year, I did a lot of studying, looking at different strategies, and I came across one called synthetic stocks. And it kind of caught my interest because I'm really good at trading long-term. I'm really bad at trading short-term. And here was a strategy that, as I read into it, I found that I could use with my long-term trading style and use the leverage that options give to significantly increase my returns. So I dug a little bit deeper into it, and I went through the process that I'm about to describe in the 4 most important rules. And I tell people that these rules a lot. So I'm sure a lot of you folks who have been with real-time trades for a while are probably tired of hearing them, but I think they're important. So I don't feel bad about stressing them enough. Those 4 rules are pretty simple. Start by paper trading. Paper trade a lot. This is something, once you find a strategy that you think you're comfortable with, it's really important to get in there and exercise it. And I say you should probably have at least 200 to 400 paper trades under your belt before you even start thinking about real money. Now, what I found with this strategy is a lot of my paper trades had to be using historical data, and Thinkorswim has a really cool tool called ThinkBack, which helps you do that. So I could get my prices and everything from a historical view. I could put that hard right line on the chart, and I traded roughly 10 years worth of to back test the strategy, actually executing paper trades over time. Once I got to that point, I said, okay, I was pretty comfortable with that, so I went with the next step, which is start with small positions. The reason I think this is an important rule to follow is because once you start trading with real money, two different dynamics come into play. First of all, when you're trading real money versus paper money, you have skin in the game at that point. So if you're like me and like most people, you'll find that there's a different level of interest than just simply paper trading. Now it really means something. You're really going to make or lose money, or both. And so starting with small positions is an excellent way to go. And that's what I did when I finally got through that first year of study. And I said, I'm not going to trade any options. And I found this strategy and I studied the heck out of it. That's when I said, all right, I'll start with small positions. I actually started with about 1/3 size of what I would really expect to be trading. And I traded that for several trades. And then I went to 2/3 size. And eventually I got to the point where I was really happy with the results that I was getting. And I said, okay, this is working for me. It's doing what I expect it to do. I'm ready to move into full-size positions. I moved into full-size positions back in about, I think it was June of last year. June of 2013. And so at that point, I had about a year and a half of study, paper trades, and everything else under my belt. And so it was time to move in with full positions. And again, I continued to be very happy with the results I was getting. But I always, throughout this entire process, I had this fourth rule in my head. And basically that is simply, if at any step the strategy is not meeting expectations, stop. It's really, you don't have to keep going. If anything, it can be challenging. It can be more challenging to stop than it is to keep going. But it's more important, if you're not getting the results that you expect, to just stop and back up and just go to the previous step. If I was trading, thanks, Steve, I appreciate that. If you're just trading, you're just moving into full-size positions and all of a sudden things stop working, go back to partial size, because what's happening is something has changed. Either the market is not reacting to what your analysis and initial trades have told you, or maybe you simply got to the point where you're not trading the way you were supposed to, but something has changed. So don't be afraid to stop. Go back to the previous step, and then make sure you start getting your expected results again. And you can apply step 4 to any phase in here. If you're starting with small positions and it's not working the way you expect, go back to paper trading, figure out why. If you start with paper trading and it's not working the way you expect, well, guess what? You probably didn't study something, or the results of your study were probably flawed in some way. So go back to the studying phase. It's not admitting defeat to go back a step. If anything, it's probably the smartest thing you can do. So if I were to tell anybody who is new, or to be honest with you, even experienced, if you keep these 4 rules as the foundation of what you do, you will succeed. You really have there's really no alternative other than to succeed. So I'm not sorry. I'm done beating that dead horse. So let's go into a little bit, and I'll talk about the description of what this is. A synthetic long stock. What is a synthetic long stock? Basically, it's a bullish trade that comprises 2 options. You have a long call position and you have a short put positions. Now, both positions are the same strike price, and both positions have the same expiration date. Let's see, Sandeep is asking, since the market is random and changes continually, would you not have to change your strategies also? Sandeep, since this strategy trades just like a stock, I would answer that by saying, do you change your long-term stock or your long-term stock investment strategies continually? I would just say, generally speaking, the answer to that's probably no. This strategy, what's really nice about it is that it lets you trade with these options just as if you were trading the stock. So no, the long-term side does not continually change at all. So anyway, you got a the rule. I meant the rule 4 below before. Not sure what you mean, Sandeep, but you want to unmute yourself and ask your question?
Oh, I didn't realize I can talk.
Oh, yes, of course.
You know, the slide that you went through before this, where you say, okay, the 4th rule, this is the most important rule. Isn't that something that will constantly happen, that the results will not be meeting expectations because the market changes?
Only if your analysis, study, and everything else did not include a scenario where the market starts doing whatever it is it's doing. When I did the back testing and paper trading and everything, I made sure that I captured the time period that included the bear market of 2008, so I could not only capture small pullbacks, retracements, corrections, but actually full-blown bear markets. So when you do your analysis, I would say that you need to make sure that you include not just bull markets, not just a very short period of time, but a long period of time, so you get as many market dynamics as possible. And then going in, you'll have a plan for what for when that happens, and it will still be, it won't be something that's changed. It'll just be, okay, now my plan said, here's what I do when this scenario arises. Does that make sense? Good. Okay, so a description of a synthetic stock position. The example I have here, say you wanted to buy a 175 June synthetic. What that would mean is you would buy a June 175 call, and you would sell a June 175 put. Very simple. And what you end up with, the resulting position, is basically the same as holding 100 shares of the underlying stock. And the reason for that is, if you're trading options, then I'm sure you've heard of things like delta, gamma, theta, and vega. Well, the neat thing about the synthetic positions is you basically are buying and selling an equal amount of gamma, theta, and vega, but you're doubling your amount of delta, roughly, and assuming delta is 50. So what the strategy, and I think it's next week, I'm going to be talking a little bit more about the Greeks. But what ends up happening is the position that you're holding is effectively 100 deltas of your underlying, which is the same as owning 100 shares of the stock. And the other Greeks are so low to the point where they're really negligible. They have no effect on the position. So that's kind of a cool thing too about the strategy is this simple trade, just like owning 100 shares of the underlying. So, so the overall view on the strategy, the long side is you've got this synthetic long stock position. I use the SPY, and again, we'll be talking more about that in the future as to why the SPY and other tickers that, or why I don't use other tickers, but why it can be used. It's a long call and short put at the same strike and same expiration. And this is another neat thing about this strategy is when the position is open, I use 9 months out as my target, because what I'm looking for is positions to expire about every quarter and going out for 9 months. And in some cases, it'll get out to be about a year. Well, what's kind of neat about, when you first put the trade on is you actually end up getting paid to put the trade on. And the reason for this is, okay, you pay money to buy the call, but generally speaking, you receive more premium for selling the put than the call costs you. So you generally tend to start the trade out with, creating a little bit of income for yourself, which is kind of neat. Now, when we enter new positions on this, we are always in a bullish mode on the market. Again, this is a bullish stock strategy. So if what we're looking for is the 1040 weekly moving average to be above the 40 week, I am much less concerned about short-term chart indications other than simply, am I bullish on the market? And the thinking behind that is if I'm looking 9 months out and I expect the stock, let's say the SPY. If I were to buy the SPY, a synthetic on SPY at $200, I would be looking 9 months out and asking, I'm bullish on the stock. Where do I think it could go? Well, historically, the SPY moves just under, I think an average is 1% per month, or I think it's like roughly 10% per year. So if I'm going 9 months out, I'm really expecting roughly a $10 increase in the value of the position I'm putting on. Therefore, multiply that times 100 shares, and that's roughly $1,000. So I'm less concerned about getting in a few cents lower or a few cents higher. I'm much more concerned simply, am I bullish? And that's the method that I go forward with. Now, I do have a protective strategy that I use with this, and that is a short synthetic. You can sell covered calls against these positions. Sometimes I do, like if we're having a small pullback, I might sell a covered call. But more likely, I'm looking for, I'll be looking at a short synthetic as for protection for short-term movement. And then, of course, if the market does turn bearish, if the 1040 weekly falls below the 1040 weekly EMA turns bearish, meaning the 10 crosses below the 40, then I'll simply start closing my long positions. When that has happened, I don't mean actually happen. I mean when that happens. Just because of the way the 1030 daily EMA works, I will already have protection in place that's profiting as the stock falls back. So if I cut losses on the long side, I can still leave my short positions out there and let them continue to increase in value. So basically, this is a bullish strategy. The 1040 is kind of the trigger that we're going to use for when to be bullish, and the 1030 is what we're going to use to decide when we need to put on protection. And I'm going to, again, protection piece is going to come. This is going to be about 4 weeks we're going to be going through this. So I will be talking about all of this in more detail. And of course, feel free to ask questions or anything like that as we go. Now, what I did, Ed says, can you briefly describe the protection? Sure. The protection is just the opposite of buying a synthetic position where I buy a call and sell a put. A short synthetic is where you sell a call and buy a put. It has exactly the opposite effect of a long synthetic stock position where you're positive 100 delta and you have no other Greeks bothering you. It's just the opposite. You're negative 100 delta and you have no other Greeks bothering you. So, and to kind of illustrate that, as of last Friday, I was fully covered in all of my positions. What that meant is, or what that means is, and you'll see this if you go look at the positions in the message that I shared in our community space. I had 6 synthetic positions on the SPY. As the market started pulling back, I got a couple indicators I was looking at, and I started layering on some protective trades. By Friday of last week, I had 6 bullish positions on and 6 bearish positions on. So effectively, all week long, my account did not move at all because I was delta neutral. I had 0 deltas, and of course, as I already said, the other Greeks are pretty much zeroed out. It did move a little bit. I think it moved like $30 or something like that. But I mean, that's just noise that doesn't come into the consideration. So the protective side is a short synthetic. And again, I will be spending some time. This is just kind of to go over some overview and basic type stuff to give everybody a flavor for what we're going to be talking about as we go in detail on this. This is a mechanical view of synthetics that I put together when I was initially doing my analysis. And what I did is I took a 20-year chart, and this is a 20-year monthly chart of SPY. And I made these little blue rectangles that were 9 months long. And I said, okay, what would it look like if I had a synthetic on at each of these times, and and basically just put every 3 months I put another one on. Where would would these be profitable or not? So if you look at here, the left side of the blue rectangle is the entry, and the right side is the expiration, right? So I went through and I laid this out, and I said, okay, well, what does this really look like? And what it was is it showed 26 winning trades and about 8 losing trades. But mother of pearl, look at the size of those losing trades. So let's see. Rand, let me get to that in just half a second. I just want to finish this chart, and I'll answer your question about buying power. So clearly, this is not something that could be weathered easily. This drop took us much lower than where we even first started. So basically, had this not been, had the short side or had the bearish side of the strategy not been looked at, would have been bankrupt somewhere probably around up here. And we don't want that to happen. So I did a little bit more analysis. I said, okay, well, what if we use the 1040 weekly to say, all right, get out of the long positions if that crossover happens. And clearly, if you eliminate those periods where we have the 1040 crossover, the returns are much better. It basically just gets rid of all these red bars. So, from just looking at it from a mechanical view without considering the details, this is something that I found very encouraging as I was doing the analysis, and it drove me to dig a little bit deeper and a little bit further and kind of fine tune the strategy that we'll be talking about. Now, Rand's asking he says, using the SPY, how is your buying power affected with one synthetic? It's not the SPY that drives the buying power, but let's use that as an example. Your buying power for a synthetic is roughly 25 times the the strike price. So if you were buying a long synthetic on SPY, and SPY was at $200, then your buying power effect would be $5,000. And what it is, it's really based on the naked put side. If you sell a naked put, your margin requirement is 25% of the underlying. Now, we're going to talk a little bit more about margin and buying power and all that stuff, but it's not driven by the ticker, it's driven by the strike price. and that's strictly talking about stocks and ETFs. I've not really dug deep and analyzed this with futures or E-minis or anything like that, so that may be different. But with the strategy overall, think of it as 25 times the value of the strike. That is with a regular margined account. And we're also going to talk briefly at some point in the future about IRA accounts. With IRAs, you have to be 100% covered, cash covered. So the strategy doesn't do a lot for you unless you decide that you want to buy a put to reduce your margin requirement. But does that answer your questions, Ram? Okay, good. Okay, so back to the short synthetics now. This is the protective side that you're asking about, Ed. So think of the short synthetic as like a short stock. It's profitable when the underlying stock moves down. It involves a short call, and this is very similar to a covered call, and it involves a long put. So you end up with negative 100 delta. And this is what I was saying before. One short synthetic for each long synthetic gives you an overall delta of 0. So basically all week last week, because I was 100% covered, my account didn't move at all. And this also applies to our group paper trading account that I update in the community space. It didn't move at all. This is the only way that I know of where you can actually, it's kind of like being long the stock and short the stock at the same time. Difference is it's at different strike prices.
Andy, quick question. This is Ed again. Sure. When you do this, I'm going to a Greek question. So I know if I had a long call and it was going against me, but I didn't want to get out of it, what I could do is simultaneously buy a delta equivalent put. That way I'm immediately delta neutral. However, depending upon direction, my long call could still perform, outperforming my short put and vice versa. Does this do anything similar?
It does. And you'll find that I look at these protected positions a little bit differently than some people do. Some people look to profit by selling the protection, meaning and let's just go with a real basic scenario. If you're long 100 shares of stock and you think the stock's going to pull back or it's hit a peak or something like that, you may decide to sell a covered call. That's a form of protection, or it's a form of income generation. But I don't look at the two as, to me, those two are entirely different reasons to sell that covered call. If you're doing it for protection, then you don't care if the underlying continues to move up because you're just going to close that protection. It was insurance that you bought that you didn't need. But if you needed the protection, the underlying goes down, well, then it's just like it was insurance that you did need, and it's going to help offset the loss that you would have felt otherwise. So just like if you were buying that long put with the same delta as your long call as a protective means, then you probably don't care if the underlying moves up again, because that was your original thesis to begin with, and you're just going to say, I don't need that insurance anymore. But I don't get hung up on trying to make money on the short synthetic. It does happen, and it's a good thing. But my real goal with the protective trade is to treat it like insurance. It's something to protect me if the pullback gets bigger than I'm ready to accept. Did that answer your question, Ed?
Yes, it seems like the real challenge would be when to take the protection off.
Yep, and that's part of the plan too. that's why I've got like 4 weeks set aside for this, because there's a lot of details that I want to cover with everyone, and how to put on the protective positions, what to expect from them, and all that is another slice of something that is important. This is a strategy that I put a lot of work into, and I don't know if you guys know Brett Pattison or not. He and I were talking about this once, and he said he used to trade synthetics, but he couldn't handle the stress that from the big swings that it could give and everything. And that's the emotional or the psychological aspects and other things that can come into play with this, which gets me back to those initial 4 rules again. But there are some big moves, so that's why the study that I put into it is what I did, and why I moved into it, and how I kind of look at everything, even after as I've been trading it, I continually look at it to make sure I'm still comfortable with the results that I'm seeing. It is a tremendous strategy. I'm very passionate about it. But there is a lot of stuff to cover that I want to cover with everyone as we go through it. So this is a little picture I put together just to kind of show you how the long stock synthetic or versus the short synthetic position look, and how they work together. Have you looked at a profit and loss graph on Thinkorswim? You're probably familiar with this. Actually, that's exactly where this came from. This is the profit and loss graph of a long stock, and it basically says, okay, the value is going to go down for every dollar that the stock goes down. It goes up the same way. For a short synthetic, it looks just the opposite. And when you combine them, you're delta neutral, and that's delta neutral basically says no matter what happens, you're not making money, you're not losing money. Which, by the way, was great Monday through Thursday. Friday was a little disappointing because the market was up so nice, but Friday was actually a signal, like I mentioned at the beginning of our meeting, that it's going to be time to start layering off some of that protection. So this is really kind of where the rubber hits the road. And what I did is I put this chart together, and I update this about every quarter. I've not updated it for this past quarter that we just finished yet. So this is through June of last year. And what I did is I took different ways to look at our performance on the strategy. And this is from our group paper trade, or our group paper account. And there's a couple things that we do in this account. We look at, or we treat it as if it were a real account that we're looking to grow with a plan of retirement, or whatever that long-term plan is. It's not an account that we set aside and just and ignore anything. As a matter of fact, we actually do weekly deposits to this account. However, the column here that says, where it says group account, does not include any deposits or anything like that. So basically, I exclude that from the analysis. So I get the real results, not anything flavored by deposits or any other actions of putting money in or taking money out. So as you can see, we started on June 30th. I'm sorry, June 30th of 2013. Went through June 30th of 2014, 12 months of data. SPY originally was at 161.21. It ended the year at 199.30. That is an absolute return if you had just bought 100 shares of SPY of 23.6%. Not too shabby for the year. Monthly return for that was 1.97. Was our monthly average return, and that's basically 23 divided by 12. In our group account, we started with 13,198, and we grew that to 20,219. That's an absolute return of 53%, or an average monthly return of just under 4.5%. So on an absolute basis, you can see those returns are pretty significant. Looking at a geometric mean, SPY was at 1.017, which is, let's call that 1.8%, whereas our account was about 3.3%. So geometric mean is a different way to look at, or a different way to compare returns that basically takes a lot of variables out by through the math. It's not difficult to do, but rather than explain it, I'm going to send you to Investopedia if you want to look into how that's calculated and what it means. Internal rate of return. This is one that a lot of people are familiar with. Again, SPY's rate of return was 23.6% for the year. Ours was 53.2. Okay, that was actually that's exactly the same as our annualized return. Huh. The one that's interesting though is, and this is where the psychology aspect comes into play. So this is our Sharpe ratio. Now, a Sharpe ratio, John showed this in one of the charts that he was talking about a little bit earlier. What a Sharpe ratio does is it takes a look at what your returns are and it adjusts them for risk. So if your Sharpe ratio is higher than your benchmark, that means you're getting the returns that you're getting at a lower risk, at a lower rate of risk. Now, as I trade this strategy, I know I'm taking higher risk. Anytime you're trading options and comparing that to the underlying, you're taking more risk. So this illustrates that and basically confirms it. But what this does is this means that I'm going to have bigger swings to the upside as well as to the downside. As I went through this analysis and paper trading and then eventually real money trading, I found that on average, the account will trade almost three times the size of the movement of the underlying. And that is, I only looked at that with SPY. I assume that it would be the same for other tickers. But that means that if the SPY were to go up 1%, then I would expect my account to move up almost 3%. The downside to that, and the Sharpe ratio shows that, is if the SPY were to go down 1%, I would expect my account to drop 3%. That doesn't sound like much, but when you see 1% in a day, that feels a lot bigger than it. Well, no, it feels as big as it is. It is a reasonable size move. So that's why I start talking about the risks. You know, where are the risks here? Like I mentioned, you know, what Brett told me is something he just wasn't comfortable trading. This, I think, is one of the biggest risks. This high leverage does mean that your account is going to make some big moves. It's great when it's going in your favor. It's horrible when it's going against you, and that's where the protective strategies are going to come into play. If we look at this picture right here, this is a snapshot I took one day last year. Our account balance at the time was roughly $18,000, and you can see movement on one day was over almost $800. Let's see. Ed's asking, does the 1040 have some overall effect upon our risk regardless of the Sharpe ratio? I'm going to get to that in a second. I think the answer is no, but I want to make sure that I understand the question. So let me get back to that in just a second, Ed. So this is, like I said, this is a real world example. This is an intraday movement, and you know, $800 against an $18,000 account. That's not small. How did that break out? In one day, our long synthetic positions were down almost 10% of our account value. That can be challenging if you're not prepared or have a plan or something like that. In this particular case, we did have a plan, and we had these protected positions and actually went on. I think it was first thing in the morning or something like that. We had looked at the chart the day before and said, okay, this is what we need to do. So this is where protection comes into play. This offset the losses pretty significantly. Now, at the time this was done, SPY was at 178.68. Anybody want to hazard a guess as to what our account did overall since that time? Not too bad. I think, actually, we can come right back up and look. As of June, which was about roughly 6 months later, it was up pretty significantly from there. So that aspect, that psychological aspect is important. It's very real. I even looked at when I was doing my back testing. I saw 1 month where the account would have lost 28%, and that was something I just said, no, that's not going to be acceptable to me. I will have a kitten if that happens. So that's kind of where I dug in and figured out how to come up with some sort of protective strategy that was reliable for me. Now, Ed, if I could get to your question, you're saying, does the 1040 have some overall effect upon our risk, regardless of the Sharpe ratio? If the 1040 is bullish, then we're entering bullish trades because the market, I'm not sure I understand the question. Maybe go ahead and speak up.
Yeah, Andy, what I'm getting at is you were comparing against a benchmark.
Yes.
And so in essence, I guess our beta is higher because we're using options, but we're also exiting the market. So we would not have been in that, entire 2008 downdraft.
Correct.
I would assume that we can't negate that effect and minimize the fact that we were not buy and holders. We didn't lose 40-something% of our account value. So that's my only question in that. Granted, if there's a period of chop, then we might underperform the benchmark, obviously during those periods, due to that fact that we're moving in and out. We have execution costs and timing effects and so forth. But during a big market move like this, we're obviously protected.
Exactly. When the market makes a move like this, we will not have our long positions in place. If anything, we'll be trading to the short side. So you're absolutely correct. Now, what the Sharpe ratio does, all that does is measure let me go back to that. All the Sharpe ratio does is measure the results after the fact. It's strictly a method of allowing you to compare yourself to your benchmark, whatever that benchmark may be. Since I'm trading options on the SPY is my benchmark. I wouldn't use ACWI. If I was trading options on SPY, I would stick with the one-to-one comparison there. If you were so inclined, you could even say, well, I'm going to use SPY times 2 as my benchmark, but that just gets a little bit too complex for me. So I don't do that. All right. So just a little bit of history on that. Protected trades were closed out for about $1,000. Long positions eventually increased by about $4,800. This is one of those situations where, again, the investor psychology comes into play. you want to have the level of confidence in how you trade any strategy, so that when something strange happens, you can look at it and go, yes, I planned for the scenario. It's okay to let it happen, or if this scenario happens, here's how I react. But that level of confidence to not be spooked, but to be prepared is really important, especially when you start considering a strategy, I think, like this. So some of the things we're going to be talking about, we're going to go through some foundation and fundamentals type stuff next week. I'll rehash probably a couple things briefly that we discussed today, but very briefly. Most of this is going to be talking a little bit about things like who this strategy might be good for, the types of scenarios that I think it would be good for. We're going to be talking about margin and buying power. That was one of the questions that came up earlier. We'll talk about diversification, how it relates to the strategy we're using, open interest, pricing, posture, sentiment, and of course, I do want to walk through the details on how to place the order, just so we make sure we cover that. And once we start getting into detail, we'll probably dive a little bit deeper into buying power. We'll go through the Greeks in depth, and then we'll start looking at more details of the plan. And some of these notes I need to update, or some of these are going to change a little bit because I've pulled stuff from future slides into what we were talking about today.